Greetings to everyone. We are the Group 6 and we are here to discuss interpreting financial statements.
This presentation is prepared by the following students. I am Evangelista Kyla P. Ibanez Red Ashley, Evangeline Hamisola, Lagrata Raven, Lopez Trixie Ann, Lim Camille, and Manankil Alea May.
To start our discussion, let us know what is the importance and intention why interpreting financial statements in entrepreneurship is important. First, it makes the business plan to be analyzed easily since in most cases, it is written precisely through numerical forms. And second, which is the real intention, is to understand and interpret financial statements. These financial statements will summarize what is going to happen to the business if the plans are carried out well. To further understand and analyze financial statements, let us begin through having a context by assuming that an entrepreneur has set up ABC Corporation.
Let us take a look at the first figure. A corporation is a separate legal personality created by law. It can sue and be sued. It can own assets. It can owe money and repay it back later. At first, ABC Corporation has nothing. However, this is where the stockholders came out of the picture. They will be giving cash to the corporation in exchange of equity of shares. The agreement between the stockholders and the ABC Corporation is this: all of the profits and losses will go to the stockholders in exchange for the cash they have proven. So, initially, the first transaction is by giving cash in exchange of issuing of stocks to the stockholders. The ABC Corporation may need more money and borrow it to the bank, which provides loans where the corporation would have to pay back in terms of principal payments and interest expenses. Assuming that the ABC Corporation is a manufacturing one, then there is a third source of funds, which is the suppliers. These suppliers will be going to give raw materials and other supplies to the corporation and would be paid later. From the cash of the corporation, it may want to invest in land, building, machinery, furnitures, and others.
In the second figure, ABC Corporation will have its own company. It will then try to activate the factory by converting the raw materials into finished goods. While in the factory, however, the corporation would need power and water, which they will pay from their cash. So cash will be spent to buy power and water, which would be used in the factory. Cash will also be used to pay for labor and supervisors, which again would be used inside the factory. So what do we have in the factory? We have the raw materials, the power, the water, the labor, and the supervisors. The raw materials are then processed in the factory. They would be called work in process inventory. When the goods are completed, they become finished inventory. Meanwhile, the accountant will have an account called depreciation. Machinery, equipment, furniture, fixtures, and vehicles would last a certain number of years. For example, buildings 20 years, machinery and equipment 10 years, furniture and fixture perhaps 5 years, and so on and so forth. And as they depreciate all of these fixed assets, the depreciation of the factory may go to the work in process inventory. We should take note that depreciation is not really included on this flow, but it is necessary to be understood in making and interpreting financial statements. Later, we will explain further why it is so.
As we take a look at the third figure, we should all know that there are other operating expenses that the corporation would have to pay for in cash. These are the salaries, supplies, electricity, and other expenses such as travel and representation rental, and so on. Take note that there are two types of cost. The cost of making the product becomes the product cost, and the the finished goods when sold become the cost of goods sold. Then there have a period costs, which is the selling, general and administrative expenses. Next, the ABC Corporation would have to pay in cash for non-operating expenses, which is really the interest expenses and other financial charges owed to the banks. Next, ABC Corporation would have to pay in cash for the government to the government for the taxes. Once that the company sells the finished goods, then they will become the cost of goods sold. In exchange, the sales or revenues are gotten from the customers.
In figure 4, we will notice that some customers will pay in cash, so the sales and revenues go back to the cash amount. Some customers would want to avail of credit. Unpaid sales become accounts receivable, and when the customers finally pay, the amount of accounts receivable transforms back into cash. ABC Corporation might have investments in marketable securities, in which case they might have non-operating income, and this non-operating income comes back in the form of cash. What does ABC Corporation do with the cash? Most of it circulates back to the operation of the company. Round and round it goes. However, some cash will be used to pay the principal of the banks. ABC Corporation already paid for the interest payments in a previous transaction. Some of the cash will be used to pay the suppliers, and again, some of the cash will be used to pay dividends to the stockholders. Remember, in the beginning, we said that the agreement between the owners and ABC Corporation is that all profits and losses belong to the stockholders. So a way of repaying the stockholders is to get portion or all of the profits and pay dividends to the stockholders.
So now let us correlate this on interpreting financial statements. First, this full figure 5 is what we call the funds flow. Funds flow going from one container to another container or from one circle to another circle makes the funds flow, except for the account of depreciation which only from imagination of the accountant. As for what Ms. Mananquil have mentioned earlier, depreciation is not really part of the funds flow. Thus, funds flow is the first financial statement that we have encountered.
The second financial statement is already on the right side of figure 5, which is called income statement. If you will notice, there are sales and non-operating income, which actually enter back to the company. However, there are expenses and costs that permanently exit the company. This entry and exit of funds on the right side of the illustration will translate to the income statement. If the sales and non-operating income were greater than the cost of goods sold, operating expenses, non-operating expenses, and taxes, then profit for ABC Corporation would be generated. However, the sales or non-operating income were less than the cost of goods sold, operating expenses, non-operating expenses, and taxes, then losses would be incurred. So, the income statement is also called the profit and loss statement. Notice that the summary of the profit and loss statement is either a profit or a loss. This is the second financial statement that we have encountered.
Through also the fifth figure, we can already see the third financial statement. Just focus on the cash container or circle. There are arrows pointing on the cash container, and these are called cash inflow. There are also arrows emanating out of the cash container, and they are called the cash outflow. Cash inflow and cash outflow constitute the cash flow.
Out of the four financial statements, we already discussed three, and all of those financial statements are flows. There's the overall funds flow, which is all the flows of funds coming in and out of these circles. There's the operating flow, which is the income statement. And the third is the cash flow. There is a fourth financial statement, however, it is not a flow.
The first financial statement is balance sheet. It is a static picture of the company at one point in. Let us say December 31 at a certain year, you may decide to take a picture of that company. At the very moment, you will find exactly so much cash in the bank or at hand, so much materials and supplies, so much work process inventory, so much finished goods, so much land, building machinery and equipment inside the company at that point in time. These are called the assets of the corporation. You will also find a certain amount of stockholders' equity, suppliers' credit, and back loans. These are the liabilities of the corporation.
Notice that on the right side of figure 5, we have the assets of the corporation, which is everything owned by the corporation, and we have on the left side the liabilities of the corporation, or everything that the corporation owes. The assets of the corporation always equal the liabilities of the corporation. And why is that? It is because the stockholders' equity takes care of the residual. If the assets generates profits, they get added to the stockholders' equity. If the company generates losses, it gets deducted from the stockholders' equity. In the process, assets will always equal liabilities. So the fourth financial statement that we have encountered is the balance sheet. And as shown in figure 6, the assets will always balance the liabilities.
There are few things to consider in making a sales summary. The first one is defining your audience. Before writing, think about who will read and what they need to know. Consider their background as well, and if they are familiar with the words you might use. Take note that it is not the same if you write for a specific sales audience or a general one.
The sales summary report shows sales within a store for a user-selected date range. The report is made up of a group of sub-reports all based on the same date range. In a balance sheet, they give a snapshot of the company's statement at a specific moment to show the situation and determine the best decision to make. In making a sales summary, we should also define the purpose of our report. We should share the monthly advancement with the top management, or just by showing the weekly overview and analysis of the sales objective with your team.
It is also important to decide on a time period. That means you can create a daily or a monthly report, or choose to display the data of the last quarter or year. You can customize the examples based on your own goals, department structure, or by the management requirements.
In gathering the right data, we can analyze what is written in the report with the help of online tools, which is especially designed to show the sales data and create analysis reports in a short period of time.
The most important part is visualizing and communicating the gathered findings because once you have analyzed the insights from your data, you have to show the information to your audience. Using a professional business tools such as Intelligence Dashboard will always let you up to date when sharing your insights.
An aspect that is often forgotten when we are deep in the reporting mindset is that numbers never tell the full story. So, it is also important to provide the context, provide some backgrounds, and a bigger picture to the figures, especially if you are presenting weekly sales report templates.
Lastly, in making a sales report, you should be creative. When building your report, add a bit of designs or touches that will catch the attention of your audience and make you more confident while presenting.
The last final component that we will discuss in interpreting financial statement is cash receipt. Cash receipt is a printed data of amount of cash received during a transaction involving the transfer cash or cash equivalent. The original copy of cash receipt is given to the customer, while the other one is kept by seller for accounting purposes. Also, a cash receipt is generated when the vendor accepts a cash or cash equivalent from the external source, such as customer or bank. Usually, the cash is known when the money is taken from the customer to adjust the balance of outstanding accounts receivable that was generated when the credit sale transaction happened. In making cash receipt, this information is stated. First, the date on which transaction happened. The unique number is assigned to the document for identification, the name of customer, the amount of cash, the method of payment, and the signature of vendor. This is an example. The following are benefits of cash receipt, such as having a cash receipt and proper filling will avoid the risk of audit issues. And nowadays, because there are numerous benefits, there are software to make a cash receipt. There are few reasons why we should need to provide a cash receipt when making a transaction. Because it serves as proof for ownership for the product purchase. It is useful for the customer in case of exchange or return the purchase item. And also useful for the vendor when he has to entertain product warranty claims from customer. Most importantly, a cash receipt is the completeness of the accounting record that support the existence of recording transaction.
This is the end of our report, and we hope that you learn a thing or two on how to interpret financial statements. Again, we are the Group 6. Thank you very much.